everybody hear me from here?
Yes.
Okay.
Can I put this here?
It is a little noisy in the background here. We were upstaged by the high school. No, I don't think so. As long as everybody can hear me. Jay's been after me to talk about insurance regulation for quite a while, and I think his first request predates our latest financial crash. So in advertising this, it tells how safe the insurance companies are. And the answer to that question is not a yes or a no, are they safe? Because it depends on what kind of insurance you're looking at as far as safety. If you're thinking about health insurance companies, they don't keep a lot of money around. They don't make a lot of investments. So they're very short-term type investments, cash. There's no difference to that. This has made relatively the financial crash had very little effect on them. Property casualty companies, pretty much the same. They need to keep a lot of liquidity, so they don't have the kinds of investments that took a bath in this crash. There are exceptions to that, though. There are companies like State Farm, which have so much equity. I mean, it's not a publicly traded company. It's a mutual owned by its policyholders, but they have so much surplus, as it's referred to in the industry, that they were actually more heavily invested in stocks than Berkshire Hathaway. They had a higher percentage of their assets in common stocks than Berkshire Hathaway, Warren Buffett's company. So they took a big hit, but it doesn't matter because they have so much money that it's not an issue. The other extreme, life insurance companies are writing policies that drag out over a lifetime. They have a lot of long-term investments, real estate, mortgages, things like that. Obviously, they've taken a big hit. When you're hearing about bailouts of insurance companies, they're talking about life insurance companies. A number of them have either bought or formed bank holding companies so that they're eligible for TARP funds. Although in the last couple of weeks, a number of them have decided they really don't need any TARP funds after all because they don't like the strings that are attached in terms of salary caps, and they don't want to be run by the Obama nation. So there's only a couple of them that are actually looking for money. One that kind of surprises me was Allstate was looking for some TARP money. I expect that to change because their stock has been doing well enough they can raise private capital without all the grief that will go along with TARP funds.
What is TARP?
Toxic, well, not toxic, but it's the Targeted Asset Relief Program, Troubled Asset Relief Program. And that was the 700, I think the first $750 billion that was set aside during the Bush administration. They have about $150 billion left. So, the interesting, like property casualty companies, where I do most of my work, for 2008, all the industry aggregate data hasn't been published yet. Usually comes out in August. But they supposedly only lost about 3% of their equity. So it really hasn't made much difference to them. A bad hurricane season is more serious than the financial crash than most property casualty companies. Now, some of the other kinds of insurance that we don't think about all the time, obviously the financial guarantee companies all were destroyed. Companies that insure the municipal bonds that then got into insuring mortgage derivatives have all been basically trashed. They were looking for special legislation to carve out the municipal bonds from all the other stuff. Shows what a complete scam the whole thing was. The fact is that most municipal bonds never needed to be insured. It was easy money for them. they got greedy and got into the mortgage stuff, they took a hit. Another insurance group that took a bath were the title insurance companies. What a title insurance policy insures you against guarantees that you own the property. And if there's a lien that goes back 10 or 20 or 30 or 50 years, they cover that. But like any other kind of insurance, when somebody's losing money, they start looking for other ways to recover, and it's cost them a money. Most of the lawsuits relate to policies that were issued 2006, 7, and early 2008. There's been a lot of instances. There's a very small number of large title insurance companies, and there's been a lot of interest by Wall Street hedge funds with money, thinking that maybe the worst is behind them and now is a good time to buy into it. And so they've had, Fidelity National, which is the largest title company, lost about, it was over $1 billion, which is a lot of money in this. And they've raised some additional capital, and there's private money out there for them now. I've actually had about 5 different investment firms contact me to ask me the same set of questions about the title insurance company. And there's 5 that write about 80% of their business. What other kind of insurance did I forget about? I think that pretty much covers it. So for the most part, everything that we buy individually is just as safe as it always was. There's also an extra layer of protection. The government always wants to protect us from our own mistakes. So there are guarantee funds run by the state, which if the insurance company fails, will pay the claims. There are limits to them, but in California, the guarantee fund will pay up to $300,000 if you have a claim or under a life insurance policy. And if it's a workers' compensation claim, there's no limits. They'll pay it all. Around the turn of the century, 99, 2000, 2001, California's workers' comp system pretty much collapsed. And the guarantee fund ended up with about $4 billion of workers' comp liabilities. Previously to that, the most they had ever paid out in a year was about $20 million. And I think in 2002 they paid out over $1 billion. So government is growing.
The cost of books so high from 20 million to almost like what the next.
Well, in the past, most insurance company insolvencies have been small companies that wrote automobile insurance, and they just weren't a lot of liabilities there. But when the workers' comp system, and it goes back to 1995, and probably even before that. Let's go back to 1988, Prop 103. Prior to Prop 103, all insurance rates in California, except workers' compensation, the insurance companies could charge whatever they wanted. There was no rate regulation in California. All you had to do as an insurance company was put together your schedule of rates and file it with the insurance commissioner and go ahead and charge them. Prop 103, the Ralph Nader socialist takeover of the insurance regulators in California made every kind of insurance in California regulated by the state. So there's no longer any free market pricing. The only thing that wasn't covered under Prop 103 was workers' compensation, because that was already regulated. But the regulation of workers' comp was a minimum rate law. The only